Picture this. It's 7:42 a.m. You open your banking app before work. Your balance is still there, but the withdraw button is grayed out. ATMs across the city are offline. News alerts begin flashing. Banks temporarily shut. Markets halted. People rush to branches, doors locked. Inside, employees don't even know what's happening. Here's the paradox. How can a world be full of money, yet nobody can access it? Because the truth is, money doesn't exist the way you think it does. And on one terrifying day, the world almost found that out. We're taught money is printed by governments. Notes, coins, physical cash. But that's only a tiny fraction of reality. Over 90% of global money is digital credit, created when banks issue loans. Think of it like this. If cash is water in a bottle, credit is water flowing through pipes. The economy doesn't run on stored money. It runs on moving money. In 2008, global debt markets were worth over $100 trillion. Every salary, business deal, and trade shipment depended on borrowed liquidity. So what happens if the pipes suddenly close? Here's how the system actually works. Banks don't keep your deposits in vaults. They lend most of it out. Mortgages, business loans, government bonds. This creates a multiplier effect. Your deposited 10,000 Indian rupees becomes 90,000 Indian rupees circulating in the economy. Now imagine trust breaks. Banks fear borrowers won't repay, so they stop lending. Other banks panic too. Interbank lending freezes. It's like a power grid shutting down. One station fails, others overload, the network collapses. No loans means no business expansion, no payroll funding, no trade financing. Money stops being created. And when creation stops, supply shrinks. Not slowly, violently. September 2008, Lehman Brothers collapses. One of the largest investment banks on earth gone. Instantly, fear infects the system. Banks stop trusting each other overnight. Credit markets lock. Companies can't borrow to operate. Some can't even finance fuel shipments or food imports. Stock markets crash globally. At one point, U.S. money market funds considered ultra-safe nearly failed. If they had collapsed, ATMs worldwide could have gone dark within days. For a brief window, the financial heart of civilization stopped beating to prevent total collapse. Central banks intervened. They injected trillions of dollars into the system, created digital money, bought toxic assets, guaranteed failing banks. This emergency action, quantitative easing, restarted liquidity, but it came with consequences. Asset prices surged, wealth gaps widened, future inflation risks increased. The system survived, but became more dependent on artificial support. Like a patient kept alive on financial life support. Here's the unsettling truth. Money isn't paper, it's confidence. As long as banks trust borrowers, markets trust banks, and people trust the system, money flows. But if trust breaks, even briefly, the world doesn't run out of currency. It runs out of belief, and belief is far more fragile than cash. So ask yourself, if money is built on trust, what happens the next time trust collapses? And when it does, will we even see it coming?